How do credit card rewards actually get paid for? If a bank gives you 2% cash back or a free flight, the money does not tumble out of a gift machine in the sky. It is recovered. Usually from merchants. Often, eventually, from consumers who do not play the rewards game well. Start with the fee stack most people never see. When you swipe or tap a card at a store, the merchant does not receive the full sticker price. Payment networks and card-issuing banks take a cut. That cut includes interchange and network fees. Rates vary by card type, merchant category, ticket size, and whether the card is a premium rewards product. Rewards cards usually cost merchants more than basic debit. That is not an accident. Higher interchange funds richer points programs that win affluent customers. Banks compete for your wallet with lounges and transfer partners. Merchants fund a large piece of that marketing war. Now follow the dollar. Suppose a diner charges a $100 meal. If the effective fee is roughly 2 to 3%, the restaurant sees about $97 to $98. The remaining pieces route through acquiring banks and networks and issuers. From the issuer's share, the bank can afford points, fraud costs, and funding portfolios. Why do merchants agree? Because cards raise conversion, ticket size, and convenience. Refusing cards costs sales. Customers expect plastic and phones. The store treats fees like rent and utilities. Painful, but part of market access. Here is the redistribution effect. Heavy rewards users concentrate benefits. They put rent-adjacent spend, travel, and groceries on premium cards, hit category bonuses, and redeem optimally. Light users or cash customers capture less. If the merchant marks goods higher to offset fees, prices rise for the whole store. People who pay cash can end up subsidizing people who maximize points. That is why some states and retailers experiment with cash discounts or dual pricing. It is also why some cafes add card minimums. The politics of who should bear the fee never ends, because the fee is invisible at the register when every shelf already embeds it. Premium cards complicate this further. Annual fees look like customer revenue for banks. In practice they are intertwined with rewards budgets, credit losses, and interest income. Some customers who carry balances pay double. Interest and fees. Customers who pay in full extract rewards and float. The bank still needs the portfolio math to clear across both groups. Airlines and hotels add partnership economics. Co-branded cards print customer acquisition. Transfer bonuses shape redemptions. The traveler thinks they beat the system. Sometimes they did relative to dumb redemptions. Relative to the full merchant-funded economy, they harvested a transfer designed to keep them inside branded ecosystems. Fraud and chargebacks also ride in the fee structure. Card networks sell trust. Merchants pay for a payment rail that reduces cash handling and some risk, then they backstop other forms of dispute risk. The product packaging hides this mash of insurance, network effects, and credit underwriting under the words earn 5 times points. So who pays for your free hotel night? Short answer, merchants pay first through higher processing costs. Then many merchants pass costs into retail prices. Then non-optimizing shoppers pay relatively more for the same shelf. Interest-paying revolvers can also overfund the system. The rewards player who pays in full and redeems well is often taking value that was priced into the network somewhere else. Is the system evil? It is incentives. Banks compete. Customers like free. Networks take rent. Merchants need sales. Everyone maximizes locally. The global result feels like free money for those who read fine print weekly. Main Street strategy if you are a consumer. Use rewards only if you pay balances in full. Optimize a simple 2-card setup rather than 7. Redeem for high-value travel transfer when the math is real. Do not spend more to manufacture spend. Manufactured spend is usually the bank's favorite customer story. If you are a merchant, track effective rate by tender type. Push PIN debit where allowed and rational. Price knowing card mix. Offer cash or account bill incentives deliberately instead of silent resentment. That is real-world economics. Points are a transfer mechanism disguised as a gift. Once you see the fee waterfall, the airport lounge looks less like magic and more like a beautifully lit bill shared by people who never entered the lounge. If this helped you see the system more clearly, like the video and subscribe for more real-world economics. It tells the algorithm to show this to more people who actually want substance, and it tells us to keep building these breakdowns.